This week, Saturday, on 5th July, we have 3 Power Pack webinars waiting for you. By 10 a.m., we have Fixed Income in 2025, Navigating the New Interest Rate Cycle. By 11 a.m., we have Porting Health Insurance. By 1:30 p.m. IST and 12 p.m. GST, NIO, War and Markets. How do war affect your portfolio? Join this webinar to gain more insights. Register now. Link given in description.
Welcome to the July 2025 Fixed Income Investment Outlook. This time we're going to be talking about the curious case of fixed income investing in 2025. Now, a lot has changed in 2025 in terms of interest rates, inflation expectations, and even growth expectations. So for any investor, the question that's on their mind is how do they navigate this new interest rate cycle that's before them? If you are one of those people who's worried about what's happening in the interest rate cycle, then do sign up for our webinar that's happening later this week. So why did we label 2025 as a curious case for fixed income investing? One thing that most fixed income investors have noticed is that despite all of the rate cuts, bond prices have actually gone down, which means that the usual relationship of bond prices and interest rates isn't really playing out. Meaning, what we normally expect is that when interest rates trend downwards, bond prices start to appreciate because older bonds hold much more value. But what has happened to investors in this cycle is that they're seeing negative returns despite the rate cuts. So what is really going on here? Let's try to unpack the dynamics of why bond prices have gone up. So one theory is along the lines of FIIs and how the interest rate differential between India and the US is at a historical low. So this essentially means that FIIs are more interested in buying US treasuries or other global bonds where they don't have currency risk, as opposed to Indian bonds where the additional compensation that they're getting is very limited. The second theory is that we're at the end of the interest rate cycle. Now, this is based on the fact that the RBI has done a lot of heavy lifting in 2025. So let's take a quick look at all the RBI's actions this year. So if we start from January to June, one of the big things that the RBI did was a lot of OMOs or open market operations where they bought bonds from bank balance sheets. This essentially infused liquidity into the banking system through OMO purchases, and this has been a consistent action for the first 5 months of the year. The second thing that we can look at is interest rate cuts. So the RBI first cut interest rates in February, then again in April, and they did a double rate cut of 0.5% in June. So a lot of people feel that we're at the end of the rate cut cycle, meaning that 5.5% of the repo is the bottom or the lowest that the RBI can go. The third thing that the RBI did was to announce the CRR cut or the cut in the cash reserve ratio for banks. Now, this is not something that's being implemented right away, but is something that will come into effect between September and December later this year. This action ensures that system liquidity remains in surplus even later on in the year, despite where interest rates are. So this is a very smart move to ensure that in the period where usually you see some kind of financial tightness, there is liquidity within the system. So given that the RBI has pulled out all the big moves, a lot of people feel that we're at the end of the interest rate cycle, which means that there isn't too much scope for mark-to-market gains. Now, let's stress the validity of all of these hypotheses, and this will allow us to see whether fixed income is still a valuable asset to own today or not. In the June policy, one thing became very clear. The RBI reduced its inflation forecast but maintained its growth forecast, which means that inflation and growth are actually in better balance, and this leaves a little bit more policy room for the RBI to cut rates. And this is something that the governor has said himself, that if inflation continues to inch down, that opens up policy space for him to cut interest rates lower. Second of all, if we start thinking about the differential between interest rates in the US and India, one thing that stands out is the fact that US yields have actually inched upwards based on a more fundamental change in the US economy. So if you're looking at the US fiscal deficit, the kind of policies they're implementing, as well as the growth and what rating agencies think US government debt is rated at, then you're seeing a fundamental shift there. So maybe the US yields are exactly where they should be and that everything is priced in. That's one factor to consider. The second thing is to look at US policy movements. So when we start studying policy movements, a lot of it is aimed towards depreciating the dollar, especially if the US wants to impose tariffs or negotiate a lot of trade deals and get other countries to import from the US. So if this is a policy priority, then you're likely to see some dollar weakness coming in later in the year. If we also study the DXY, it's been fairly volatile, but this has not been a great year for the dollar anyway. So this is a data point that we should be tracking before we make conclusions about what a fair differential is. More importantly, we also need to look at the Fed's policy, which was also announced in June, which should give us more insight as to where US interest rates are heading. If we look at the data that's come out from the summary of economic projections, one thing is fairly clear. You're seeing a higher level of inflation, a higher level of unemployment, and a lower level of growth according to this month's summary of economic projections. This is the second time that they've made these kind of revisions in 2025, which means the US economy is actually heading towards a more precarious place and could require policy support in the form of interest rate cuts. If we study the dot plot as well, one thing that stands out is that the US Fed is expecting at least 2 more rate cuts in this year. Now, lastly, we need to look at where global growth is. When we look at the RBI's commentary, a lot of the time they've not been worried about the Indian economy per se, but just about how global factors could affect our growth trajectory. And the way things are looking with all of the wars that are waging, as well as the kind of policies that are getting implemented, you are seeing a slowdown in global growth. And if the global economy slows down, there can certainly be spillover effects to India, which means that if our growth continues to be low or even more sluggish than where we are today, and inflation also is within control, there is room for interest rates to go lower. While this is a contrarian stance to take, it seems like an obvious one. When we study all of these factors together, it looks like fixed income still has a lot of value and merit in an investor's portfolio. This is not something that everyone is advocating, but maybe a safer investment today could be the right one for your portfolio. If you'd like to know more about fixed income investing or what you can do with your investments, you can reach out to us at 9500 27285.